studying your last two. I swim med tid when they turned in. The styrene down to mute. And can lend a pole that sunk he died.
Let's look at how a salary or bonus can be used to eliminate a shareholder loan balance. Imagine that an owner-manager has withdrawn $85,000 from the corporation during the year. Those withdrawals were not recorded as salary and were not treated as dividends. As a result, the accounting records now show a shareholder loan account with a debit balance of $85,000. Rather than treating the amount as a loan that must be repaid, the corporation may decide to compensate the shareholder for services they provided to the business. The process begins when the corporation formally approves a salary or bonus for the shareholder. Since many shareholders in owner-managed corporations are also employees, it is often reasonable for the corporation to pay compensation for their work. Once the salary or bonus is approved, the accountant records a payroll entry. Instead of asking the shareholder to return the money, the salary expense is applied against the shareholder loan account. In simple terms, the corporation is saying that the money previously withdrawn will now be treated as employment income rather than as a loan. This accounting adjustment reduces the shareholder loan balance. In many cases, it eliminates the balance entirely. Before the adjustment, the books show a shareholder loan balance of $85,000. After the salary or bonus is applied, the shareholder loan account balance becomes zero. At that point, the shareholder no longer owes money back to the corporation. However, just like the dividend method, eliminating the shareholder loan does not eliminate taxation. The key difference is that the shareholder is now receiving employment income rather than dividend income. This means the amount will be treated as salary or bonus compensation, reported on a T4 slip, and taxed under the employment income rules. From a tax perspective, the transaction has been completely reclassified. What originally appeared as a shareholder loan is now recognized as compensation for work performed. This is one of the most common year-end adjustments made by accountants for owner-managed corporations. The key takeaway is that a salary or bonus can eliminate a shareholder loan balance by converting the withdrawal into employment income. The loan disappears, but employment income takes its place, along with all of the tax and payroll consequences that come with salary compensation. Now that we have seen how a salary or bonus can eliminate a shareholder loan balance, let's examine the tax and payroll consequences that follow. One of the biggest differences between using salary and using dividends is that salary creates employment income and triggers payroll obligations. Let's follow the process step by step. The corporation decides to clear the shareholder loan balance by treating the withdrawal as salary or bonus compensation. Once the salary is declared, it must be processed through the corporation's payroll system. Unlike dividends, salary is not simply a bookkeeping adjustment. Payroll calculations must be completed, payroll records must be maintained, and the corporation must comply with CRA payroll requirements. From the corporation's perspective, there are several important advantages. First, the salary is recorded as an expense of the business. Because salary is generally deductible, the corporation receives a corporate tax deduction for the amount paid. This reduces corporate taxable income and can lower the corporation's overall tax liability. In many cases, this corporate tax deduction is one of the primary reasons accountants consider salary as a compensation strategy. From the shareholder's perspective, the treatment is quite different. The shareholder now has employment income. That income must be reported on their personal tax return and is taxed according to the employment income rules. The corporation will issue a T4 slip showing the salary or bonus amount along with any applicable deductions and contributions. Unlike dividends, salary is generally subject to CPP contributions. This means both the employee portion and the employer portion of CPP may need to be calculated and remitted to the CRA. As a result, salary often creates additional costs and compliance responsibilities that do not exist with dividends. The corporation must maintain payroll records, make payroll remittances on time, follow CRA payroll rules, and meet all required filing deadlines. These obligations continue even though the original objective was simply to clear a shareholder loan balance. This is why accountants often say that salary solves one issue while creating a completely different set of responsibilities. The shareholder loan account disappears, which is beneficial. However, employment income is created. Payroll compliance becomes necessary, and additional calculations must be performed. The key takeaway is that salary provides valuable tax advantages because it creates a corporate tax deduction. But those advantages come with payroll obligations, CPP contributions, reporting requirements, and ongoing administrative responsibilities. Understanding both the benefits and the compliance requirements is essential when deciding whether salary is the right method for clearing a shareholder loan balance. Now that we've seen how salary can eliminate a shareholder loan balance and the payroll consequences that follow, let's look at why accountants often choose the salary method and why it is usually more complicated than using dividends. One of the biggest advantages of salary is the corporate tax deduction. When a corporation pays salary to a shareholder employee, that salary is generally deductible to the corporation. This reduces corporate taxable income and can lower the corporation's overall tax bill. In contrast, dividends are paid from after-tax corporate profits and do not generate a corporate deduction. Another major benefit is the creation of RRSP contribution room. Because salary is considered earned income, it allows the shareholder to accumulate RRSP room for future retirement savings. Dividends do not create RRSP contribution room, which is why many owner-managers choose salary as part of a long-term retirement strategy. Salary also provides recognized employment income. This can be very valuable when applying for mortgages, personal loans, financing arrangements, or other situations where lenders want to see stable employment income reported on T4 slips. In addition, salary can support broader financial planning goals, including retirement planning, estate planning, and long-term compensation strategies. However, these benefits come with additional complexity. The first challenge is CPP contributions. Both the employee and employer portions of CPP may apply, increasing the overall cost of the compensation arrangement. The second challenge is payroll processing. The corporation must establish and maintain payroll records, calculate deductions, prepare payroll reports, and comply with CRA payroll requirements. The third challenge is payroll remittances. Source deductions and CPP contributions must be remitted to the CRA on time, creating ongoing administrative responsibilities throughout the year. And finally, there is the issue of gross-up calculations. This is one of the more difficult concepts for many owner-managers to understand. Imagine that the shareholder has already withdrawn $85,000 from the corporation during the year. If we decide to treat that amount as salary, we must still account for income tax withholdings and CPP contributions. As a result, the actual salary required may need to exceed $85,000 so that, after deductions, the shareholder ends up with the intended net amount. This often requires careful calculations and planning by the accountant. That is why salary is usually considered more complicated than dividends. When deciding between the two methods, accountants typically evaluate several factors, including the value of the corporate tax deduction, the cost of CPP contributions, the importance of RRSP room, the shareholder's personal tax situation, and the additional payroll administration required. The key takeaway is that salary often provides the most comprehensive tax planning benefits available to owner-managers. However, those benefits come at the cost of increased compliance requirements, additional calculations, payroll obligations, and greater administrative complexity. For that reason, the decision between salary and dividends is rarely based on a single factor. Instead, it is a balancing exercise that considers both tax efficiency and practical administration to achieve the best overall result for the shareholder and the corporation.